Good evening, Swapnil. Yeah, and Kamini, I've shared the file for the last lecture. Welcome, guys, those who have joined. Let's wait for a few minutes so that others can join as well, and then we'll start. Last lecture's file has been uploaded in the chat box. Kamini, I hope you have found it. Good evening, GA. A very warm good evening to everyone. Let's wait for a couple of more minutes so that we can be a good strength to start with, and then we will resume with the last class where we left off. Good evening, guys. Good evening, everyone. Okay, so let's revise a bit. Let's revise a bit. So today, most probably, we will be done with the DCF model, and then we will be starting with relative valuation part. Okay, but let's revise a bit. So today I conducted some mock interviews and asked few of my students to walk me through a DCF model. So what could be the expected answer for this question? And this is a question that could be asked in a financial modeling interview or a financial analyst interview in most of the cases. So there is a high probability then that when you will be going for a financial analyst interview or any of the interview in a core finance domain, they will ask you to walk them through the process of DCF valuation. So DCF valuation basically works on the simple principle of time value of money, where the principle is the present value of the future cash flows is calculated to determine the intrinsic value of the company. Present value of the future cash flows are calculated to determine the intrinsic value of the company. Now, what is intrinsic value of the company? Intrinsic value of the company is nothing but should be price. What should be the price of the company? What should be the price of the company is what its intrinsic value is. Based on intrinsic value, we come to a target price. If we feel, if we calculate that target price of the company is greater than its current market price, that is, if intrinsic value of a company is greater than the current market price, then the security is, if the target price of the company is greater than the current market price, then the security is overvalued or undervalued. It's undervalued. I'll summarize it up all again. Just give me a second. And if current market, those who have joined late, if current market price is greater than target price, the security is overvalued. So basically, the whole idea to, I'm starting again. So the whole idea to do a DCF model, to make a DCF model is to come to something that is called intrinsic value. Intrinsic value. Now, what is intrinsic value? Intrinsic value is nothing but should be price of the company. Should be price of the company. Let's suppose you are searching for a property. Let's searching for any of the asset, not only property, gold, silver, stocks, bonds, any of the asset. Let's suppose you are trying to invest in any of the asset. So how will you determine that you should invest in that asset? Whether you should invest in the asset or whether you should not invest in the asset. How will you determine that? So to determine that, you will compare the today's price, that is current market price of that asset. Compare it with what? Compare it with the future benefits associated to that particular asset. You will be calculating the present value of all those future benefits that you are about to receive in future. And that present value in case of DCF valuation is intrinsic value. Now, if current market price is greater than all the future benefits that you are, is greater than the present value of future benefits that you are going to receive in future, you will invest in a security, in that security or not. If current market price is greater than the present value of all the future benefits that you are going to receive in future, whether you will invest in that security in that case or not, whether you will avoid investing in that security or whether you will invest in this kind of a security where the current market price is greater than present value of future benefits. Obviously not. Correct? Because the price that you are paying today is higher than the benefits that you are going to receive in future. Now, let's suppose this can also be implemented in various scenarios. For example, a real estate property. Let's suppose you are planning to invest in that property for investment purpose. In this case, you are going to find that what are the cash flows that this particular property is going to generate in the coming future. You will be calculating present value of all those cash flows. You will be calculating the present value of all these future cash flows, coming to the intrinsic value, and then comparing that intrinsic value or the present value of all those future benefits with the price of the property. If the price of the property outweighs the present value of future benefits, you will avoid the property. If present value is greater, if you feel that the future benefit I will receive from this asset is greater than its current market price, at that point of time you will be buying the asset, because you are considering this as an ideal investment. Why ideal investment? Because the price that you are paying today, you are going to receive more benefits out of it in the coming future time. Okay, so this is the idea of DCF valuation. And the purpose of DCF valuation is to calculate intrinsic value. DCF works on a simple core principle that the intrinsic value of the company is nothing but the present value of all its future cash flows. Now, to get the future cash flow, we have forecasted some future cash flow, that is FCFF. We have forecasted FCFF, free cash flow to firm. Now, free cash flow to firm belongs to both equity and debt holders. Free cash flow to firm belongs to both equity and debt holders. When these free cash flow to firm is calculated in present value terms, what we get is a value for the whole firm. If this is FCFF for year 1, FCFF for year 2, FCFF for year 3, and so on. When we calculate the present value of all these future cash flows, now, how we calculate the present value of all these future cash flows? If something is standing in the future and we want to make it to the present, we are going to pull it back. We are pulling it back. See, we are pulling it back. So pulling and pushing is the term used for compounding and discounting in terms of corporate finance. So when we have some future cash flows and we are pulling it back, we are actually discounting it. On the other hand, if we have a present value and we want to find out the future value of it, we are compounding it. That is, we are pushing it forward, pulling it back and pushing it forward. Remember these two terms. Based on this, when we discount FCFF, free cash flow to firm, and calculate its present value, we get value for the whole firm. What is value for the whole firm? The value for the whole firm is called enterprise value. Enterprise value. Formula for enterprise value is market value of equity, plus market value of debt minus cash. I'm writing this down for this formula again. The formula for enterprise value is market value of equity plus market value of debt minus cash and short-term investments. What is the intuition behind this formula? Now, what is... Okay, Prajwal, what part have you not understood till here? Please let me know, because this is something that we are revising from the past class, the present value and FCFF approach and discounting approach. This is what we are revising from the past class. That is why this part was a bit fast. I agree with you. But the reason why this was fast, because we are revising it, right? Now, this is new part. The enterprise value part is, I think, new for you guys. So what is the intuition behind this enterprise value thing? Now, let's suppose you are going to buy a locker. You are going to buy a locker. The owner of that locker, and there are many jewelries inside that locker. There are cash inside that locker and assets inside that locker. The land papers, the property papers are inside that locker. Now, if I ask you that, okay, so I am the owner of the locker and you are buying it. I am the owner of the locker and you are buying it. And pledging this locker, I have also taken loan worth rupees, let's say 2 million. Pledging this locker, I have also taken loan worth rupees 2 million. So if you want to be the owner of the locker without any debt, if you want to be the 100% of the owner of the locker, what it would mean to be 100% owner of this locker? what it would mean 100 to be the 100% owner of this locker. Everything which is inside that locker, everything is in, that is every treasury which is inside that locker. If you feel that it should belong to you, if you want to be the 100% owner of that locker, in that case, you will have to, and I am the ask price of this locker. I am asking you 5 million for this locker. So everything which is inside this locker, if you want to own it, you have to pay me 5 million. You will have to get me this 5 million, and also you will have to repay the debt that is associated to this locker. You will also have to repay the debt to be associated to this locker. Otherwise, what would happen? Otherwise, a part of the treasury would go to the debt holders. Do you guys agree? The part of a treasury which is inside the locker would go to the debt holders. So if I ask you what is the total amount that you need to pay to get everything which is inside this locker, is 5 million plus 2 million. 5 million is for the part of owner, that is equity holder, 2 million for the part of debt holder. But also there is 3 million cash inside this locker. Now, when you own this locker, the cash inside this locker also belongs to you. So this 3 million cash is effectively subtracted, because when you will buy this locker, on the spot itself, you are getting 3 million of cash. So effectively, what is the amount that is going out of your pocket for being the 100% owner of that locker? It is 4 million. And that is the idea behind this enterprise value, where that the whole enterprise is considered as a locker. The whole enterprise is nothing but the locker. It will generate cash, and based on that, okay, I'll explain with a different example as well. Just give me some time. Let's suppose you are buying a car. That the owner of the car you are buying, why is cash subtracted? I'm coming to that again. Why is cash subtracted from the locker? I'm coming to that again. Let's suppose the owner of the car had bought the car for 10 lakh rupees. He has used that car for 3 years and took a bank loan on that car for 5 lakh rupees. With this example, if with the locker example, if it is not clear, don't worry, it will be clear with the car example. So let me just complete and you will be pretty much clear with it. I'm definitely sure about it. Let's suppose that 10 lakh rupees is the price at which owner bought the car. Out of that, 5 lakh rupees is the loan amount that he had taken. 3 years later, he had repaid 2 lakh rupees out of that car. He had repaid 2 lakh rupees, and the outstanding amount is now to be repaid to the debt holder. The outstanding amount is to be repaid to the debt holder is 3 lakh. Why? Because out of 5 lakh, 2 lakh rupees has been repaid. Now the question is, in these 3 years, when the owner used the car, he has set up additional accessories in the car worth rupees 1 lakh, and which can be dissociated with the car and immediately could be sold off. So let's suppose he has established a MP theater in the car, or a sound box in the car, which is worth 1 lakh, which can immediately be sold off. Now, this was a kind of a short-term investment in the car, kind of an asset in the car that he installed. Now, he is asking you to pay 4 lakh rupees for this car, and outstanding debt being 3 lakh. Total 7 lakh is going out of your pocket. Total 7 lakh rupees is going out of your pocket. So what is this 4 lakh? Market value of equity plus market value of debt. Till this part, everyone is clear. I am coming to why we need to subtract cash and short-term investment. Till this part, is everyone clear about it? Market value of equity plus market value of debt. Everyone? Guys, are you there with me till here? Those who ask me the doubt, Ronak, PM, Pooja, Pragati, Prajwal. Perfect. Now, why cash is subtracted? Now, let's suppose that 1 lakh rupees of amphitheater is being sold. Okay, PM. Do you have any doubt in this still? If I buy a house, do I need to pay remaining EMIs? Yes, if the if that particular house has the outstanding loan and then loan is going to be transferred under your head, under your title, then you will have to pay the remaining EMIs of that house. So, so that car, that car has assets or removable assets worth rupees 1 lakh. So if you want to fund that car, once you own that car, you can immediately sell 1 lakh rupees worth of assets. So the total amount that you require to buy that car is not 7 lakh rupees, but only 7 lakh minus 1 lakh, that is 6 lakh rupees. Why 6 lakh rupees? Because 4 lakh rupees is to be paid to debt holders, 3 lakh rupees is to be paid to equity holders, but 1 lakh rupees of assets you can sell immediately out of that car, and making the financial arrangement for you would only be demand of 6 lakh rupees. Only 6 lakh rupees you will need to be the owner of that car, because you can immediately sell off assets worth 1 lakh. So Subhendra is saying that values of these accessories can be decreased with time. The decreased value is 1 lakh rupees. The decreased value of that asset is 1 lakh rupees. Whatever may be the amount he may have bought it for. Now, yes, so here we are going to calculate the effective amount we need to fund the purchase of that particular asset. Now, we are not going to use this for buying a real estate property. We are not going to use this for buying a treasury box. We are not going to use this to understand it for buying a car. What we are going to do is we are calculating this in the context of a company. What if you are going to acquire a company? So the enterprise value of the company, if you want to get all the earnings of the company, by what I mean by all the earnings, EBIT, earning before interest and taxes. So if you want to get earnings as well as interest of a company to be the owner of that company, you will have to pay its equity holders. Let's say equity holders are asking for 10 million for offloading their 100% shares. So you will have to pay that 10 million. Debt holders, let's say debt holders have the outstanding debt of 3 million. And finally, that company might also have $2 million in cash. So now, since you are the owner of the company, that $2 million will belong to you now. So do you need 13 million in total? The answer is no. Why? Because 12 million is already in the company. And once you are the owner of the company, you will get that 12 million. So that is why we are subtracting this 2 million, that is cash and short-term investments. Why we are subtracting? Because let's say I have paid 13 million to be the owner of the company, and 2 million is the instant cash that I have received, instant discount that I have received. So eventually what I have paid is 11 million. It's not a discount, but the cash that I have received being the owner of that company. So eventually I have paid 11 million. Are we clear with this? Yes, this cash subtraction is done once while calculating the enterprise value. Okay. Shall we start with the modeling part if you guys are clear with this? Yeah, but that would be somewhat a confusing statement, GA. So GA is saying it simply means that we can't pay cash to acquire cash. Why? For PPE, percentage of sales, other assets, percentage of sales, and few others, why are the moving averages taken? Okay, let me go to the modeling part, and then we will see what is happening over there. Okay. Okay, GA, let me know your doubts as well. Well, we will not withdraw all the cash, so we have to pay full amount only now. Yes, practically yes, but we are not going to deduct all the or take back all the cash from the company. But basically, that once you have paid the cash, that cash belongs to you. So that you are the owner of that cash now. So that is why the effective amount paid by you is less. Okay, Subhendra has asked something. Sir, to become 100% owner, we should have to purchase all the equity. Yes, here I am not talking about the 100% owner. You are truly correct. If we want to be the 100% owner of the company, uh, we are just going to purchase the equity part of the company. But what if we are going to, if you want to be the owner of 100% EBIT, that is operating profit of the company, all the profit that operating profit that the company generates, if you feel that profit should belong to you, you should not only own the 100%, you should not only be the 100% owner of the company, you should not also have any outstanding debt to be distributed to debt holder. Only then the interest expense will be zero and all the operating profit will belong to you. So that 100% owner of being to be the 100% beneficiary of EBIT, you need to pay off debt as well as equity. In forecasted cash flow statement, the dividend paid for current year should be the dividend which is declared previous year. Okay. In forecasted cash flow statement, the dividend paid for current year should be the dividend which is declared previous year. Okay. In the forecasted cash flow. But this is GA related to the accrual concept of accounting, if you remember. So the cash flow statement, if you see, okay, Subhendra, I'll come to the equity part as well. So this is, I think, remember to the cash flow. This is accrual concept of accounting, so that if dividend is declared today, it is dividend is distributed in this year itself. So probably all these dividends that has been declared, dividend paid this year is out of the profit of last year, but technically it is calculated like this only. Dividend income, the screener is following the same concept like for year 2024. So is screener following like the this year dividend is the dividend for last year. So dividend payout ratio will be calculated based on last year minus 3597 3930. The exact link between the income statement, balance sheet, and cash flow statement is not matching between screener. If you see that, just give me a second. If you see over here, the values that cash dividend is directly been paid, dividends paid 2719 and dividend is 2718. Okay. Minus 5437 minus 1812. Which is declared in 2023. Okay, minus 1812. Just give me a second. Yes, yes, yes. So yeah, we will have to, if that is the case. I never tried to look at it in a so detailed way, but if that is the case, yeah, we will have to do it. But how then dividend payout ratio will be calculated? Okay, dividend payout ratio is correct. So we just need to forecast in that case the dividend for the coming years. 2026, 27, 28, 29, and 30. For the rest of the 5 years, we will need to calculate the dividend, because for the last year dividend would be this year dividend that is being paid. It would be the last year dividend only. But in that case, how will our uh, okay, reserves? But in that case, will our balance sheet get matched? So you are saying this is going to happen minus And then we will have to take dividend for the last dividends paid. $3930. Just a second. Okay. And for the future years onwards, we are going to calculate the dividend. That would be so for this year also we will have to here we will have to change the dividend part as well. Okay, we will get to it. We will come back to it. I got your point, GA. Thanks for highlighting it. So yeah, we will be changing it. But let's get done with the first. Let's get done with the DCF part first, and at last we will be. So he has made a very genuine point over here, guys. Have you guys understood what he is saying? He is saying that if dividends are declared, the net profit is generated for the year. And once the net profit is accounted after the closing balance of the income statement, balance sheet, and all, then let's suppose the net income is generated for the year 23-24. Based on the net income it is generated, the company will declare the dividends for 23-24 in year 24 and 25. So the cash flow balance, the cash flow payment of dividend that is to be distributed in 2025 should be based on the dividend that is declared in 2024. This is what he's saying. Guys, are you understanding what point he's trying to make? A very genuine point that the dividend declared in 2024 based on the earnings of 2024 will be paid in the financial year 2025. So the dividend should be based on last year dividend. So we will have to adjust. We will have to make two adjustments with respect to this based on the cash flow statement and balance sheet. Okay. So we will be doing that in few minutes, but let's get done with the DCF part first. Okay. Were we done with the beta regression? This is the slope. This is the slope of beta is calculated as slope of market uh, change in stock upon change in market, change in stock upon change in market. Now, in the long run, beta has a tendency to regress towards 1. What I'm trying to say is that in the long run, it is observed that beta keeps on fluctuating in between a level. So the short term beta can deviate from 1, but in long term, beta comes near 1. If same is the case, if beta is below 1, it will come towards 1 in the long run. Okay, so now we will have to regress this beta. Various investment bank has various weights for beta, but JP Morgan, which is one of the investment bank, has given weight of 1. Sorry, is my voice breaking, guys? Is my voice breaking? Okay, is it any better now? Okay, okay, perfect, perfect. So what I was saying is beta has a tendency to regress towards 1. So what is the face value of the company? Face value is of the company when the company shares are vested. It means that it is registered for a particular amount. That amount that appears earlier, you used to get physical certificates for shares, right? So that amount that was mentioned in the physical security in the face itself, that was the face value of the company. So to get a share registered at a given value, uh, in legal terms, it is called the face value. So that is the face value for a company. Okay. Now, where were we? Yeah. So various companies have given various weights to beta. So when beta, we want to regress beta towards 1, weight, we will have to give a weight to beta, weight of beta, or weight of raw beta. This beta is called raw beta. Once we adjust this beta, we will get the adjusted beta. So weight of raw beta, JP Morgan gives the weight of raw beta to be 25%. And if we want to calculate the adjusted beta, we will be multiplying the weight of beta plus 1 into 1 minus weight of beta. And as you can see, this will move beta. I'm sorry, guys, there was a network glitch. Just give me a second. Give me a second. So yeah, guys, there was a network glitch. That's why we got disconnected in between. Okay. So what I was saying is, in the long run, when we move, when we trace the trajectory of beta, beta regress towards 1, beta moves towards 1. So now the beta is 0.06, 0.6264, 6264. Now the beta is 0.6264. But as we move forward, beta will move towards 1. So we have to adjust this beta so that it moves towards 1. To do that, we assign weights to beta. We assign weights to 1 and we assign weights to beta. Now, let's suppose we have assigned weight 75% to beta. Why we are taking 75%? Because a leading investment bank called JP Morgan takes 75%. Different investment banks have different weights. Some take one, some put 1/3, 2/3 weight to beta, that is raw beta, and 1/3 weight towards 1. JP Morgan puts 3/4 weight towards beta, that is 3/4 is nothing but 75%, and 25% weights towards 1. Now, next thing, so we have calculated, we have adjusted that beta that was 0.6264. What does this beta says? This beta measures the volatility of a stock. This beta measures the volatility of the stock with respect to the market. With respect to beta measures the volatility of the stock with respect to markets. What would that mean? If market moves by 1%, beta will move by 0.6%. If market moves by 1%, beta will move by 0.6%. So moving forward, we have adjusted our beta towards 1. We will be doing the editing part and reducing the decimals. So 0.63 and 0.72 is the adjusted beta according to the weights given by JP Morgan. Now, moving forward to the data sheet, now we are doing the DCF part. Yes. So linking beta with what we have got as adjusted beta, enter. Then we need to calculate the weighted average cost of capital. Remember, guys, what is the formula for weighted average cost of capital? We discussed this in the last class, I guess. What is the formula for weighted average cost of capital? Waiting for your comments. Yes. So weight of debt into cost of debt. Very good. Plus weight of equity into cost of equity. No, adjusted beta will be 0.72 because the weight of 75% is given to raw beta and 25% is given to 25% is weight is given to 1. That is why the weight of beta would be 0.7. Okay. First of all, we need to calculate weight of equity, weight of debt or weight of equity, cost of equity, weight of debt, cost of debt. Okay. Also remember this cost of debt is post-tax cost of debt. This is very important. This cost of debt is post-tax cost of debt. So I am writing now post-tax. Now to get this weight of equity, weight of debt, cost of equity, cost of debt, we need few things. We need to calculate weight of equity, we need total capital and equity. So for that, we will need to get some valuation data. We need to calculate Alt H MC. I am doing just merge and center. What I am doing, I am selecting this whole range. I am selecting this whole range, going to home, merge and center. Now, what is that? Valuation data. We need few things, total capital. For total capital, we need total debt or long-term debt because short-term debt will be paid off in this year itself. Long-term debt. Then we need market capitalization. With total capital and long-term debt, we will have for total capital would be long-term debt plus market cap. That is long-term debt is nothing but market value of debt. Since market value of debt is very difficult to calculate, we generally consider book value of debt as market value of debt. So market value of long-term debt, we will go to financial statements and we have our borrowings with us. Since this business has a very short part of long-term debt, it's 118.60. Then we will go to calculate market capitalization. We will go to data sheet. We have the market capitalization value with us. So with this, can we calculate weight of equity? Yes, the formula for weight of equity will be market cap divided by total capital. We need cost of equity. For cost of equity, we will need to calculate cost of equity using CAPM, capital asset pricing model. For that, we need risk-free rate RF plus RM minus RF into beta. So yes, formula for cost of equity is through CAPM is RF. Did I give you guys logic behind this formula? RF. In the last class, did we discuss the logic behind this formula? Yes, in previous class, we discussed the logic behind this formula, right? Why we need equity risk premium. Why do we need to add the equity risk premium? Why do we multiply it with beta? Perfect. So with this, we are getting the formula, or sorry, we are getting the value of cost of equity as 12.17%. Then we need weight of debt, long-term debt divided by total capital. Then we need cost of debt, generally the YTM of the bond that the company issue is taken. But since Maruti Suzuki has not issued any bond and the other methods get a bit complicated and would be very much difficult for you guys to be implemented, we will keep it simple. What do you do for weight of equity? For weight of equity, it's total capital divided by equity. Total capital divided by equity. Cost of equity is RF plus RM minus RF into beta. Weight of debt, long-term debt, that is market value of debt divided by total capital. Cost of debt, we will be considering interest expense divided by borrowings. The interest expense for this year will be based on the borrowings for last year. Till last year company, all the borrowings that company made will be the interest expense for the company this year. So that is interest expense divided by borrowings. Interest expense divided by borrowings. That is 16% becomes the cost of debt. WE should be equity upon total market cap. Yeah, this is what we did, right? No. It should we should be equity upon total market cap. How could it would be equity upon total market cap? The market capitalization itself signifies the market value of equity. What is market capitalization? Share price multiplied by number of shares. So this signifies the market value of equity. So out of the total capital that the company has, what percentage is contributed by equity? 99% of the capital is contributed by equity. This is what it shows. The formula for KE is RF plus RM minus RF into beta. Okay. So this is weight of debt, a very small portion of debt. Cost of debt is 16%. Now, what we need next? Okay, this cost of debt is post-tax cost of debt. Now we will have to also incorporate the tax rate. We will have to incorporate the tax rate. The corporate tax rate in India is 25%. So we will be incorporating the tax rate. Post-tax cost of debt is pre-tax cost of debt multiplied by 1 minus tax rate. Pre-tax cost of debt is post-tax cost of debt multiplied by Please explain weight of equity again. Sure. So let's suppose you need total 1000 million to run a business. The total capital requirement for your business is 1000 million. Now, if you feel that 300 million of that total capital is being contributed by equity, 300 million of the total capital is contributed by equity, what is the percentage of total capital that is being contributed by equity? Out of 1000 million, 300 is contributed by equity. So can I say that is 30% of total capital? It means that weight of equity is 30%. What is the interpretation for weight of equity? Out of the total capital, what percentage is contributed by equity? That is weight of equity. Okay. Was I clear this time, PM? Perfect. Moving on, we have our back with us. That is weighted average cost of capital. Just give me a second, guys. Really sorry for the disturbance. Okay. Next, we will be forecasting the future years. We have already forecasted the future years. We are just going to plot it now. So these are the future years. We have calculated actually FCFF, free cash flow to firm. Just give me a second. Alt HOI to adjust everything accordingly. We have did Alt HOI. Now, as you can see, Alt HOI. Okay, perfect. Now, FCFF, we have free cash flow to firm. Let's plot that. FCFF. Okay, this is our FCFF. And we are more concerned about the FCFF for future years. Next, how many of you are aware about the concept of terminal value? So we will have to just shift to the whiteboard again for introducing you to the concept of terminal value. Now, just give me a second. Let me share both. Okay. Now, these are the cash flows that the company is expected to generate for the coming future, for the next 6 years. These are the cash flows that the company is going to generate for the next 6 years. But will Maruti Suzuki stop working after 2030? Do you feel that Maruti Suzuki is going to stop working after 2030? Everyone, please do reply. No, right? Company works on the principle of going concern. It means that the people would go, but the company would still keep on working. So this company is going to generate cash flows till perpetuity. Company is going to generate cash flows till perpetuity. Now the challenge over here is to calculate the future cash flows. So can I just calculate the future cash flows for perpetuity? Can I just do that, calculating the future cash flows for perpetuity? Should I just keep on forecasting the future cash flows for perpetuity? The answer is no. So what we do is we try to calculate the terminal value. Now, what is the terminal value? All the cash flows that the company is going to generate from 2000 after 2030, that is from year 31, 32, 33 onwards till perpetuity, we are going to calculate the present value of all those cash flows. We are going to calculate the present value of all those cash flows. Are you guys getting this? Guys, are you getting this? We are going to calculate the present value of all these cash flows. Now, I will deviate a bit for one moment from this, and I will ask you one thing. Please do reply if possible. Let's suppose I am planning a retirement. I am planning a retirement or a person aged 60 years is planning for retirement. Now, based on his assumption, when he is going to retire at the age of 60, his monthly expense considering inflation would be 3 lakh rupees per month. Would be 3 lakh rupees per month. That is 36 lakh rupees per year. 36 lakh rupees per year. Now, he sees that the investment that is safe, or not safe is not the right word, the investment suitable, for his risk appetite, for his ability to take risk, gives him 18% return. The investment that is suitable for his risk profile gives him 18% return. Now, he wants to accumulate a sum of wealth. He wants to accumulate a sum of wealth amount so that he can withdraw 36 lakh every year. He can withdraw 36 lakh every year till perpetuity. So what I am trying to say, he wants so that he can get 36 lakh for first year, second year 36 lakh, third year 36 lakh, and throughout the life he wants 36 lakh to plan his retirement so that he can live a happy life after retirement as well. What amount should he invest today so that he is able to generate 36 lakh of return, only the return component of 36 lakh every year? What is the amount that he should invest today? How are you going to calculate it? Yes, GA, you are correct. Correct. Fire strategy. No, I am just asking for a simple formula. So PM, what is fire strategy? Do let me know about it. CAPM. No. CAPM is used to calculate cost of equity. DCF, yes. We are discounting these future cash flows, 36 lakh, which is 36 lakh every year, to get the present value of all the 36 lakh till perpetuity. And the formula is very simple. A by I. A by I. What is A? Annuity. Annuity is the annual payments that you will be receiving every year divided by I, that is interest rate. Annuity upon interest rate, that would be 36 lakhs. That is nothing but 3.6 millions divided by 18%. Do 36 lakh divided by 18%, you will get 2 crores. You will get the value of 2 crores. Conversely, think of it like this way. Let's suppose you have 2 crores. Let's suppose you have 2 crores and you are able to generate 18% return per year. What would be the return that you are going to generate every year? What is the return that you are going to generate every year till perpetuity? 36 lakhs is the return that you are going to generate every year till perpetuity. The retirement problem resolved. He is able to serve his retirement. Based on the same logic, we are going to calculate the cash flow for terminal year. We are going to calculate the cash flow for a terminal year. What is terminal year? The year after which we are assuming the company to be in going concern and trying to calculate the present value of all the future cash flows from the year onwards. Are you getting this? That would be my terminal year. I would be calculating that terminal value and discounting back that terminal value to calculate the present value of terminal value. I am going to calculate the present value of that terminal value to get the value of firm. Are you guys comfortable till here? Are you guys comfortable till here? Perfect. Now, for the next 6 years, we have calculated the value of FCFF to be 47,437.12. 47,437.12. The next year, the value of the firm would be last year into 1 plus growth rate. Now, we had not put the growth rate of terminal value. This growth rate would be nothing but long-term GDP growth rate. Search for long-term GDP growth rate of the of India, because Maruti Suzuki is being operated in India. Search for long-term GDP growth rate of India and give me the source. With a strong economic outlook projecting growth rates of 7.0% in 2024 and 6.5% in 2025. We want long-term growth rates. For 24, it was 7.24, 9.05, minus 5.83. Growth looks like in 25, 6.5%. On calendar year basis, India's growth projection for 7.3%. Okay. For India, outlook 10-year GDP growth rate of India. So it is on an average 7% from 24-25 into 2029 to 30. It is saying that the long-term growth rate for India would be around 7%. Can average till 7.5% till 2023. This is the source. Nomura, that is one of the investment banks, is sourcing that India's GDP growth can average at least 7.5% per annum for this decade if the economy witnessed a faster than expected revival of private investment. The Tokyo headquartered investment banking firm said India's growth rate to be 7% from 2024-25. Okay. So most of the articles are quoting 7% for the year 2024-25, and in the long term it can go to 7.5%, but we will be keeping a pessimistic scenario, an average scenario, and quoting it to be 7% only. Long-term GDP growth rate for India. Now you might be wondering, this is given for year 2024-25. So in the financial year 2024-25, the long-term GDP growth rate is quoted as 7%. So this is the long-term GDP growth rate quoted in financial year 2025. So we are keeping it 7%. Based on this, we have got a future value for plus 365 for the next year. Oh, I'm sorry. Have I changed the risk-free rate? Okay, 7.00%. Okay. now is equals to last year into, sorry, last year plus 365. Okay. Now I want to get the terminal value. What was the terminal value? A by I. Why I am calculating the next year FCFF to get the this year terminal value? Because remember what is the idea behind DCF? DCF is the present value of future cash flow. So to calculate present value for 2030, I will need future cash flow. And what is future 2031? That is annuity. A by I. So the formula for terminal value will be FCFF for the next year divided by WACC, weighted average cost of capital. Have we calculated WACC? Not yet. So we need to calculate WACC. Formula for WACC would be weight of equity into cost of equity plus weight of debt into cost of debt. That is 12%. Now, let me just copy the format. This will be my terminal value is equals to this year divided by WACC minus growth rate. The next year FCFF divided by WACC minus growth rate. Why WACC minus growth rate? Because if I want 12% return, if the cost of capital is 12% for the firm, 7% is been already contributed by. Why did you consider terminal year to be 2030? It could have also been 2029, 28, 27, because we are making 5-year, 6-year projection. We have forecasted the income statement for the next 6 years. If you see from 2025 to 2030, we have forecasted the data, forecasted the financial statement for the next 6 years. We cannot just forecast the financial statement till perpetuity. So there has to be a full stop till which we are going to forecast the financial statements. And the year after that would be considered as the growth rate for the free cash flow to firm from the year after the terminal year will be considered based on the long-term GDP. So why I have considered it till 2030 to be the last year of calculating terminal value? Simply the reason being because the forecast of the financial statements has been made till 2030 only. If I would have made the forecast till 2035, I would have considered 2035 to be my terminal year. Now, we want to calculate present value of future cash flows. And that present value of future cash flows would be my enterprise value. That present value of future cash flows would be nothing but my enterprise value. So I want to calculate my enterprise value. How am I going to calculate my enterprise value? So I am going to use NPV function is equals to NPV. The rate that I am going to use is WACC, comma, I have been asked for value 1, 2, 3. So first of all, I will have to calculate the total of FCFF and terminal value for this year. Now, I am going to calculate NPV, net present value. The rate would be WACC, comma, value 1. This is my value 1. Value 2. I could have directly dragged it as well, but still. The syntax says to put it comma, so a more professional way to do it is through commas only. This is my enterprise value. This is my enterprise value based on scenario 1. If I change this to scenario 2, my enterprise value will also change. And this is my new enterprise value 316. In scenario 3, what is my enterprise value? 14902. Less debt, less debt. We have long-term debt for the company. Yes, we will be taking break in the next 5 minutes. Let us just get done with this. What was the formula for enterprise value? Market value of equity plus debt minus cash. Formula for enterprise value was market value of equity. Why is WACC used as rate? Because enterprise value is value of whole firm. Enterprise value is value of whole firm. What is the return to whole firm? Weighted average cost of capital. So the return to the equity holders is cost for the company. The return to the equity holders that the company provide is the cost for the company. The return to the debt holders that the company provide is cost of debt for the company. Return to the equity holders, cost of equity. Return to the debt holders, cost of debt. Based on, if we want to incorporate returns for both, since we need to incorporate returns for both because free cash flow to firm are cash flows to both equity and debt holders. So the rate considered is WACC because WACC is the return to both equity and debt holders. Should EV have increased in scenario 3? No, since we are moving from a bull case to a bear case scenario, the EV should have fallen down. Next, enterprise value. Formula for enterprise value is market value of equity plus debt minus cash. Market value of equity plus debt minus cash. Now, how will I have market value of equity? I have my enterprise value with me. I have my debt value with me. I have my cash balance with me as well. How am I going to calculate? How am I going to calculate my equity value? Can I write based on the formula? Equity value is enterprise value less debt plus cash. Enterprise value less debt plus cash. Can I say that? And logically, if you want me to explain, the owner, the company as a owner, what value I have in the firm after deducting the debt and adding cash to it, the value that the firm has belongs to the equity owners of the company because cash belongs to the equity holder after paying off the debt. So to get the equity value, I had enterprise value with me. I will do less debt, add cash. I will do less debt and add cash. I will have equity value is equals to enterprise value minus debt plus cash. I need cash balance for this. So let me just add cash and cash equivalence as well. Cash and cash equivalence. Cash and cash equivalence. Make sure you take last year cash balance. Control C, Alt T. Finally, we will be coming to a target price for the company. Number of shares outstanding. Why last year and not 2030? Because we are evaluating based on today. Today is 2024. So that is why we are taking the latest available data. We are not evaluating the firm based on standing on 2030. That's why. We want to evaluate what is the present value of the firm. Number of shares. Do we have number of shares with me? If not, we will have to go to data sheet. Number of shares is 31.44. These values are in crores, I guess. Assumption. Let's keep that assumption to the base case scenario. And finally, the value that we will get is what we have worked very hard for, entering them in 2015. We are not entering them in 2015 anymore. Alt H1. We are not entering it in 2015. We are just entering it. So this is not based on 2015 actually. There is nothing to do with 2015. We could have entered it anywhere since this is the format that we are following. So similar to like these values are not in the part of 2015. This is also not the part of 2015. We will edit it. We will make the changes in format. Based on that, we will be able to get that this value is not for 2015. So equity value divided by, so 10,152 is what we are getting in a base case scenario. In the best case scenario, what is the firm intrinsic value? It's 19,232. Current market price of the firm is 12,104. Is it 12,104? It increased actually. It has crossed 13,000. From last two trading sessions, the Maruti Suzuki has shown a very volatile trading experience. The quarterly results were very good for Maruti Suzuki, but some inflation news related to US didn't turn it into the favor. So the global index were low, and thus was the impact reflected in Nifty as well. So in Friday, we saw a sharp decline of around 400, 200 to 250 points, approx 200 points a decline in Nifty. The quarterly results reported by every company in Nifty is turning out to be good. Recently, Nifty crossed 25,000 mark as well. So on Thursday, we celebrated that. DCF intrinsic value is 19,232. Now, what is the intrinsic value in a bear case scenario? I think it would be around 5,000, 6,000, 7,000. It's 4,854. So according to our analysis, if there is a worst case scenario for Nifty, the Nifty, the price of the Nifty would be 4,854. If it is the best case scenario for the market, sorry, not Nifty, but Maruti Suzuki, if it is the best case scenario for Maruti Suzuki, the price should go up beyond 19,232. Okay. Now we are going to edit this. This should never be in dollars. This should not be in dollars, guys. Make sure you change it to rupees. Yes, you guys can have a break. Meanwhile, let me take care of the editing part, and then we will be starting with the relative valuation part. So I'm just adding few lines. Could you please show how was the EV calculated using terminal value? So equity value is uh, terminal value is net present value. We could have also calculated it based on, okay, I'll give you a different perspective for it as well. We could have also calculated this based on the concept of, based on using the concept of time value of money as well. So let's say this is my first year, this is my second year, and this is my sixth year, right? So formula for present value would be future value divided by 1 plus r raised to n. This is what we could have calculated. We could have named this as present value of future cash flows. Present value of future cash flows, and that is okay. I will drag this formula for the next 5-6 years. I will use the sum is equals to sum function and add this. Just give me a second. Okay, I'm really sorry. Okay, we will have to freeze here back as well. This rate should be freezed. And doing this, we will get same value as 601972, 601972. So what these NPV functions do, it calculates the net present value of the future cash flows. The rate has been taken as 12% and the future cash flows had been taken for the respective future years. Now we also have to make the changes in recommendation made by Gaurav. So we will be adjusting for the last year dividend as well. So just go on a break, guys, but be right back on time. Be right back in next 5 minutes. Meanwhile, let me just edit this, make few adjustments to this. Finally, recommendation is equals to if this logical test, this intrinsic value is greater than current market price value if true, buy, value if false, sell. Can you also show why was the terminal value added in the last forecast part? Because businesses works on the principle of going concern. What this terminal value represents? It represents the present value of all the future cash flows that the company is going to generate in future years. All the present value of all the future cash flows that the company is going to generate in the future years, that is being calculated in this part, that is terminal value. Okay, based on the similar concept of A by I, annuity divided by interest rate, that we covered over here somewhere, based on the terminal year. Yeah. So as we wanted 36 lakh 18% A by I, cash flows divided by interest rate. This is what we did. Cash flows divided by interest rate. The reason why we subtracted growth, because this cash flow is not constant. Here we supposed cash flow to be constant. This cash flow is not constant. It has been growing with 7%. So we need to subtract growth in the denominator. Mhm. Then we will go to conditional formatting, highlight cell rules equal to by in green color. Or conditional formatting, highlight cell rules greater than okay, just give me a second. Um, Conditional format, highlight cell rules equal to by green color. Okay. if the same cell rules equal to cell, then we would want in red color. Perfect. Big firms ESC recommendation देते हैं, तो buy and sell इतने फंड से infuse कर देते हैं. So they give recommendations to the market participants. They publish research reports based on these recommendation, and many people react to those recommendations and invest in such firms. So it's not evident that they themselves invest in those companies or not. Sometimes these are also subject to manipulation. Some companies might also offer some sort of a bribe to these firms to inflate their market values, especially when they are indulging in stock to for a purpose of stock acquisition. So all the companies want to get their value inflated in the market, or if promoters want to offload their shares, they tie up with research houses and also tries to give the recommendation which is somewhat biased. But SEBI, that is regulator, have watch on this, and if anyone is caught in such kind of an activity, they are penalized with huge fines. Beta is calculated through the regression approach. Current market price, Steiner.in. Growth rate of terminal value, pib.gov.in. NPV for 2030. That will be NPV for 2030. Yes. Net present value from the future years till 2030. But there, the reason why we are using this formula, because we had a single cash flow over here. In this case, that is while being standing on 2030. In today's term, we had different cash flows, like cash flows for the next 6 years. So NPV is a better function to use over here, although you can also calculate it manually. Investment in model, as the company is holding the same investments across the forecasted year, so it continue to receive same interest on it in cash flow statement. Let me see. Investments 57296. Capital work in progress, other income. So see, GA, either what we could have done is we could have also raised investments over here based on percentage of sales or percentage of total assets, but we didn't did that kind of a thing over here, just because to make the model simple. Otherwise, if we keep on adding the percentage of sale terms or percentage of total asset terms or adjusting it in terms of every line item, initially those who are new to the modeling part would find it very difficult to get the balance sheet matched. So to keep it simple, we have kept it over here. Generally, as our cash flows, as the company move forward, as we can see the trend, the other income part that is increasing over the years, it will continue to increase, and it is an appropriate assumption to assume that it is going to increase as well. And if you see that these cash flows, this is a three statement model. Anything that we do with this model won't be affecting the DCF part of the valuation, if you are able to see, because the FCFF is only calculated based on the element of the income statement. And we have current assets and current liabilities involved in this model. So anything related to fixed assets or anything related to cash flow from financing activities or investing activities won't be affecting the valuation of the model. The reason why we have made the future valuation, so that to understand the interconnectedness of the model. So if every one of you are back, let's try to solve the suggestion given by GA. From the investing activity should also be same. Interest received. Yeah, but in this case, if we are making it interest received, interest paid for financing activity, interest received in investing activity, have we incorporated it over here? We have not incorporated interest received from financing or investing activity over here. So we don't need to make any adjustments to it over now. If we would have, and other in, although we are including net income over here or EBIT over here, earning before interest and taxes, EBIT over here. So other income is already been calculated and incorporated in EBIT. So we don't need to make again adjustment for it over here, if you see. So that is why we have avoided it. So yes, if the investments have been same, the interest received should be same, ideally. But since these cash flows does not affect our valuation to a greater extent, we are avoiding the complications for now. Because if people are not able to match the balance sheet initially at this moment of time, what they would feel, initially I used to feel like giving up on this. But since once we will move from basics to a step forward towards the complicated part, we are going to enjoy the process. So that's why, to not make the curriculum much more burden with uh, complicated concepts, probably the team might have made this. And probably I also feel that the based on the crowd, and some of them are not from the finance background, some of them are from science background or arts background. It's essential to keep things a bit simple as well. Nevertheless, the process that you will be involved in while working will also be, you will be trained for that process in every company. Because the process, although the concepts are same, process changes from company to company, although the roles might be same as well. So for the same role, you will be trained for the new process that you will be joining for. Nevertheless, let's incorporate the suggestion given by GA about the dividend part. The dividend paid in 2025 should be the dividend that was declared based on. Yes, this is difficult, and that's why I try to keep it as simple as we can. But you need to practice it, and after making 4-5 models, I'm pretty much sure you will be comfortable doing so. So this is the dividend. The dividend for this year would be nothing but the dividend that was declared last year based on last year net income. So this is our dividends. Now, since we have adjusted dividend in cash flow statement, we will also need to adjust reserves as well in our cash flow statement. And that would be, so around 1,000 students have uh, been trained in data trained itself in the investment banking part. And to be very honest, none of them highlighted this till now. So kudos to GA that he is being so attentive. Even Priyanka was very attentive, but since I don't know, for some specific reasons, probably because of timings, she might have not been connected, but she was also very attentive. So I have praised these two guys earlier as well. So very good, GA. Keep it up. It was a very good observation. Even I have never observed this in last 1.5 years. Okay, fair enough. Now this year adjustment is made. So we have just substituted the dividend of this year with the last year. And yeah, we are done with our model. Now I will have to clean the model. You will have to make these notes. Or let me just do one thing. Let me just add a new segment to this called trash and where tab color, and here you can have your rough sheets. Dividend part won't affect the valuation, right? Has it affected the valuation? Equity value, number of shares, enterprise value, NPV. Okay, let me check how does it flow and based on what. It has increased the cash flows, and based on this new assumption, what is the valuation that we are getting in a base case scenario? 10,925. FCFF, EBIT, tax expense, current assets, Okay, okay. So dividends are affecting cash, cash are affecting current assets, and based on that, the valuations are also getting affected. Fair enough. Thank you, GA, for highlighting this. Also, now, one thing that if you remember that we made, that we adjusted all the points to decimals. Because of that, these percentages signs have also been converted into decimals. Sometime while working on the model, while doing the model on your end as well, you can make these blunders. And this was a blunder from my end. Now the question is, how quickly can you rectify your mistake? How quickly can you do this damage control? Because this was a relatively shorter model. When you are going to make a real financial model, a professional financial model, it could be up to 20, 25, 50 pages. So making a blunder like this can cost you 1 month of 1 month of efforts. So there are few tricks that you can do is, first, if you have selected this, if you can select this, all these line items that you want to change in percentage terms. How am I selecting this? Dragging the mouse and using control. Keep control pressed and drag the mouse. Keep control pressed and drag the mouse. Don't don't change your hands. Don't remove your hands from the control button. Select this and drag the mouse. See, I removed my hands by mistake from the control button and it disappeared. So GA, any efficient way of doing this? Changing all the signs to percentage part. Ideally, what we should have done is formatted every row as we constructed it. Shit, shit, shit. Okay. Change this to percentage. So all these figures are directly being changed to percentage. Keep it to 2 decimals. And based on this, once and then select row and press F4 for rest of the rows. Yes, that would also work. So what she is saying is, what Maniar is saying, this copy this format, Alt ST, Alt ST, Shift space, function F4, function F4. All these are in already percentage terms. These are also in percentage terms. We didn't do anything over here. Alt ST, Alt HP, Alt H0, Alt H0, Control C. And one more important thing, guys, you will have to, yes, first for few, um, for first time initially, we will have to copy this. Then we can use F4. So like this, we can change it. So based on this, you can change it as well. I am sharing this sheet with you. Okay. Now, I'll share this sheet with you by the end of the day. We will make some more changes to this sheet, adding the relative valuation part on Maruti Suzuki as well. Now, Now there are various valuation approaches. Now there are various valuation approaches. We covered DCF valuation approach, that is discounted cash flow valuation. This is based on the concept of time value of money. Now, I tried to make you explain this discounted cash flow valuation approach. It will also be available on the portal. I will also share it in the chat box. We covered discounted cash flow valuation approach. I gave you an example that let's suppose you want to sell a property. Let's suppose you want to sell a property. Now, how will you determine? I am the buyer of the property. You are the seller of the property. How are we going to determine that what should be the fair price of the property? What should be the fair price of the property? How are we going to determine? How will we come to a common price point? Any idea? The one of the approach that we discussed was DCF valuation, where we will calculate the future values, future benefits that the property will generate me, and try to calculate its present value and compare it with the price of the property. Now, what could be the other approach of valuing that particular property? The other approach that could be used is called a relative valuation approach. Is called a relative valuation approach. What is relative valuation approach? You will try to find the nearby properties, the nearby deals that has recently been happened near your locality. Based on that deals, if your neighbor has sold the flat for 10,000 rupees per square feet, you will try to sell it at least at 10,000 rupees per square feet and greater than it. So the transaction price of your neighbor's property or the last transaction that happened in your locality became the reference point to determine the price of your property. So here you are valuing your asset based on the relative value of some other asset. That is relative valuation. That is relative valuation, and relative valuation over here works based on few set of ratios. Those ratios are, please try to note this down. Those ratios are price to earning ratio, second, price to book value, third, EV to EBITDA, price to revenue, fifth, EV to revenue, sixth, EV to EBIT, seventh, price earnings to growth, price earnings to growth rate, and the last one is based on dividend yield. Dividend yield. Based on these 8 set of ratios, we are going to determine the price of our target company. Now, either we can make the model on Maruti Suzuki itself, and if you want, you can suggest the company of your choice, and we can make the relative valuation on that particular company that you guys suggest me. Based on a common consensus, we can come to a company based on which we can derive the value of the company. Okay. VT is saying Coca-Cola. Coca-Cola is not listed in India, not listed in Nifty, I guess. So Coca-Cola won't work. Any company related to EV, EV is a sector, not a company. Kotak Mahindra Bank or ITC. Okay. HCL Technologies. Tata Motors. Try to, these are few suggestions that I'm getting. Jubilant Foodworks. Okay. Banks, Bandhan Bank. We don't have any data for Ola yet. Ola has not came up with the IPO, neither it is listed in the stock market. HDFC Bank. Any pharma companies? Cipla, Lupin, etc. Mankind. Cupid is a pharma company. So finalize Reliance Industries. Reliance is a conglomerate. So we will have to working on Reliance. Okay, yes, we can work on Encure Pharma as well. MRF Tires. Okay. We can, Emcure Pharma has recently came up, but the data would be, the data available for Emcure Pharma would be very less. But still we can work on Emcure Pharma as well. Vedanta. Okay. Try avoiding monopoly businesses. Yes, AV. Try avoiding monopoly businesses, because the reason being, relative valuation is the approach used to value companies based on their peers. How can we value a monopoly business if we don't have any peers? Okay, a government defense company like, also government defense companies, how many companies are available in government defense sectors? That is also something that we can consider. Nestle or FMCG. So the ideal companies for the relative valuation is the companies that have more peers associated to it, like pharma, like FMCG, like automobile in India. ITC is, again, I feel it is a conglomerate. It has a larger or a monopoly share in uh, cigarettes and tobacco sectors. So there would be accurate peer available for ITC. We can also go for IT services. Let's try to finalize our industry first. Shall we go for FMCG or pharma? Because we have already done with automobile and IT services. You can also go for IT services. Let's go for FMCG. Okay. If every one of you allow, let's go for FMCG. Fair enough. Now, based on FMCG, select a company. Now, let's search for companies under FMCG. Give me a common, give me a very famous name of a FMCG company. Maybe Hindustan Unilever. So we will go to screener. We will search for Hindustan Unilever. I'm not saying that we will be making the model on Hindustan Unilever. You can see the screen, right? Okay, now you guys are able to see the screen. Hindustan Unilever, Colgate P&M. So sector FMCG. In FMCG, we have ample amount of companies. So what among the top 10 companies do you want us to work on? Britannia or Dabur or P&G, Varun Beverages, Nestle, Hindustan Unilever, any of the company of your choice. HUL, Varun Beverages, Nestle. So everyone is having diversified views. Let's just randomly select in any of the, based on any of the criteria. Let's go for the company with highest cash. Okay, let's go for the company with highest cash among the top 10. So this is the random selection that I have made, as it wouldn't be possible for all of us to come to a common consensus. So let's go for a company with the highest cash. It's Hindustan Unilever. Okay, want to play again? Want to go for a different company if you don't like Hindustan Unilever? You can go for a company with highest EBITDA. Again, it would be Hindustan Unilever. So can we just make the model on Hindustan Unilever itself? Or the third highest company based on market cap? Like any of the company, the third highest company based on market cap. The third highest company based on market cap would be Control C. I will be copying this, pasting it in the Alt TSV. Copy Alt TST. Alt HY. We will screen not visible. Just give me a second. It will be visible. So what I have done over here is copied the data. We are going to copy the data, and let's go for third largest company based on market cap. Third largest company based on market cap. Select this whole. We will select this whole thing. Home. Just give me a second. Really sorry because there is heavy rains in Mumbai. So that is why we are facing fluctuating network because of that. So I'm really sorry about it. Now is it visible? Is the screen visible now? Guys, are you guys there? Am I clearly audible? So whenever any such things happen, please don't leave the class. Be there in class for 5 minutes. I'll join back. If the class gets ended automatically, you will receive a link on the mail. Okay. You will receive a new link on the mail. We will solve this largest to smallest. Third largest company based on market cap is Varun Beverages. So we will be making the model on Varun Beverages. Okay, we will be finalizing Varun Beverages and making the model on Varun Beverages. The reason why I didn't select it Hindustan Unilever, we could have also gone for Hindustan Unilever, but I think Hindustan Unilever is a very common name. The values that we would have received, many of you might have already heard or seen the model on LinkedIn related to Hindustan Unilever. So let's go for a company. Uh, Actually, it was luck based as well. So let's go for a company very which is not very common. V VBL, Varun Beverages have monopoly over what? Does Varun Beverages has any monopoly business? We also need to look into that as well. Varun Beverages is a part of RJ Group. Varun Beverages Limited has been associated with PepsiCo since 1990s and is a key player beverage industry and one of the largest franchise of PepsiCo in the world. The company produces and distributes a wide range of carbonated soft drinks and non-carbonated drinks and packaged drinking water. What are the peers of Varun Beverages? Hudson Agro, Zydus Wellness, Larsen Turbo Foods, Mrs. Bector's. Food processing industry, FMCG and food processing, okay. So, okay, we have Zydus Wellness, Pikachi Foods, Hudson Agro. Has been limited over decades and achieved a position of largest private dairy sector, marketing, milk, and FMCG business. Okay, so it's also essential to go to. It would be good. It would be a good company. Okay, let's. If that is the case, Varun Beverages. Do we have exactly common peers of Varun Beverages with us? A set of common peers of Varun Beverages, which gives products or services very similar to what Varun Beverages gives. What does L&T Food gives? Limited Incorporated is primarily engaged in business of milling, processing, and marketing of branded and non-branded basmati rice. So we cannot compare. Only Reliance is there for Campa. Okay. So we cannot compare Varun Beverages with their peers because although the industry is same, the similar, but the exact peer is not available. Exact, to be very honest, close peer is also not available because Varun Beverages gives carbonated drinks and the nearest peer is, I think, as people are saying, it's Campa. United Spirits, I guess they give alcoholic beverages and not the common ones. So let's go for a common company. Let's go for Dabur. Yes, a uh, core FMCG companies. Godrej Consumer, Imami, Jotani Labs, Bajaj Consumer. I don't know why Yash Optics is present over here. Personal kind FMCG. Hindustan Unilever, Nestle, Varun Beverages can be part of the FMCG. Godrej, Britannia, Dabur, Colgate, and Palmolive. So yeah, let's go with Dabur. It has many common peers and close peers associated to it. So we will go with Varun Beverages. Oh, sorry, not Varun Beverages, but Dabur. So we have finalized the company. We will be going with Dabur. Now, if you guys remember, I have given you the set of ratios. I have given you the set of ratios. All those ratios are not available with us now. Okay. So those ratios were, just just download the name of the ratios or write down. Have you guys written down the name of the ratios? It's price to earning, price to book value, EV to EBITDA. Very good. GA has written that already. So we have that ratio with us. I'm posting that ratio in the chat box. I am writing down that ratio in the chat box. We will be continuing discussing on each and every ratio tomorrow. We will be continuing our discussion on each and every ratio tomorrow. And then we will be continuing with the class. In case you feel you have any doubt, You can bring those doubts to the class tomorrow. We can discuss on those doubts. If you have any suggestions for the class, please do mention that as well. And tomorrow we will be making the model on Dabur India. Tomorrow we will be making the model on Dabur India. And make sure you you read a bit about Dabur India, what products that they actually service. And we will be continuing the discussion on all these 8 set of ratios. And based on these 8 set of ratios, we will be calculating the intrinsic value of the firm through a different approach called relative valuation approach. Okay, so that was it for the day, guys. I hope you enjoyed the session. I hope that you love the DCF modeling part. Keep practicing, otherwise you will forget what has been covered. So thank you. Thanks a lot. It was very wonderful interacting with all of you. We will keep on having new discussion over the sessions. Please, I am open to suggestions. Please give suggestions how we can improve on from our end. And we will continue from tomorrow where we left off today. So we will be continuing with relative valuation model. Thank you guys. Have a great night. See you again tomorrow. Bye bye. Have fun. Thank you. Thank you.